In 2008, the global financial system nearly collapsed. A toxic cocktail of bad loans, reckless deregulation, and unchecked Wall Street greed brought the world economy to its knees. Nearly $19 trillion in household wealth evaporated. Millions lost their homes, their jobs, and their futures. But while the rest of the world was riding the housing boom and celebrating the party, a handful of eagle-eyed investors saw the house of cards for what it was. They didn't just sound the alarm, they placed billion-dollar bets that the entire system would come crashing down. And when it did, they made fortunes while everyone else was left holding the rubble. You might know it from the best-selling book or Oscar-winning film The Big Short. Now this is the story of what actually happened, and it is even more dramatic than Hollywood made it look. This is the story of the outsiders, the misfits, and the contrarians who took on the entire financial system and won. But their victory came at a cost no one talks about. It all started with one man, a set of spreadsheets, and a bet that everyone on Wall Street thought was insane. The year is 2005. Wall Street is swimming in money and the housing market is untouchable. But in a small office in Cupertino, California, a former neurologist named Michael Burry is losing sleep. Burry ran a modest hedge fund called Scion Capital. He wasn't a Wall Street insider. He'd started his investing career writing about value stocks on internet message boards in the late 1990s, attracting the attention of firms like Vanguard. He was eccentric, blunt, and had been diagnosed with Asperger's syndrome. But what made Burry different was his obsessive attention to detail. Through 2003 and 2004, Burry had been studying the actual loan-level data inside mortgage-backed securities, the paperwork that almost nobody else bothered to read. What he found terrified him. The bonds backing the housing market were stuffed with subprime mortgages given to borrowers who clearly couldn't repay them, many of which carried low teaser rates that would reset dramatically higher within 2 years. He predicted that once those resets hit, a wave of defaults would begin, potentially as early as 2007. Burry wanted to short these bonds. The problem? There was no way to do it. You couldn't just sell mortgage bonds short like regular stocks. So, Burry did something audacious. He went to the biggest banks on Wall Street, Goldman Sachs, Deutsche Bank, and asked them to create a brand new financial instrument for him. A credit default swap on subprime mortgage bonds. In essence, it was an insurance policy that would pay out massively if the bonds failed. The banks were of course happy to sell it. They thought it was free money. So by October 2005, Scion Capital had accumulated over $1 billion in credit default swap exposure, essentially betting against the housing market. It was the most expensive insurance policy in Wall Street history. I want to buy insurance on these subprime mortgage bonds. You want to bet against the housing market in America? Yeah. Did you hear that? We'll take your money, Doc, all day long. The banks laughed. They took Burry's money and moved on with their day. But what they didn't realize was that Burry's trade had lit a fuse, and it was about to spread. Now, before we continue, it's time for a quick word from today's sponsor, Southern New Hampshire University. SNHU is one of the largest accredited universities in the country, with over 200 degree programs, many online, and everything's built around flexibility. No set class times, you can work where and when you want within your existing life, and that way you can pursue a new career while still working full-time. They offer programs in history, business, finance, and more, helping you to pursue a program that matches your interests. SNHU's programs are also flexible. With no set class times, you can learn on your own schedule when and where you want. You can even transfer up to 90 credits you've already earned, whether they're academic, military, or experiential. Now, as someone passionate about business and finance, SNHU offers several different programs to choose from and can ultimately help you pursue a program you're passionate about. Click the link in the description or go to the snhu.edu/casual economics to explore over 200 degree programs and find your path forward. And with that, back to the video. Burry wasn't alone for long. At Deutsche Bank, a brash mortgage trader named Greg Lippmann was running his own numbers. Lippmann was the bank's global head of asset-backed securities trading, and he was one of the first Wall Street insiders to grasp what Burry's trades implied. After learning that a bank had sold Burry a CDS, Lippmann used his own quant analyst, Eugene Zhu, to verify the thesis, who concluded Burry was most likely right. Lippmann began building a massive short position for Deutsche Bank, ultimately growing it to $5 billion. But he also went further. He became a one-man evangelist, pitching the idea of shorting the housing market to every hedge fund that would listen. Within Deutsche Bank, colleagues nicknamed him Bubble Boy and Patient Zero. He became the man who spread the short housing market thesis across Wall Street. And one of the people Lippmann pitched was Steve Eisman, a sharp-tongued financial analyst at FrontPoint Partners, a hedge fund under the Morgan Stanley umbrella. Eisman wasn't new to subprime. He had covered the first generation of subprime mortgage lenders in the 1990s and had watched them all blow up in 1998. When the second generation emerged in the early 2000s, often run by the same people under new names, Eisman smelled the same rot. By early 2006, Eisman's underwriting standards for US mortgages had become a dark joke. As he later put it, by early 2006, the underwriting standards in the United States were, "Can you breathe?" Eisman directed FrontPoint to begin shorting subprime mortgage investments by acquiring credit default swaps. Eisman had made his bet. Now all he could do was wait and hope the market couldn't keep pretending forever. But Eisman and Lippmann were still Wall Street creatures, insiders who at least spoke the language of the big banks. The next group of players in this story, well, they had no business being anywhere near this trade. Perhaps the most improbable characters were Jamie Mai and Charlie Ledley, two 30-year-old friends who in 2003 started a money management firm called Cornwall Capital, out of a backyard shed in Berkeley, California, with just $110,000 in a Schwab account. Mai and Ledley weren't Wall Street professionals. They had no formal training in trading, but they had a powerful insight. Markets often misprice extreme events. They specialized in finding situations where the crowd was overly certain about an outcome and then betting on the possibility that everyone was wrong. When they heard about Lippmann's pitch on credit default swaps, reportedly stumbling onto his research through word of mouth, they recognized the housing market as a massively asymmetric bet. The cost of the insurance was cheap, and if it paid off, the returns would be astronomical. The problem was that Cornwall was too small to play at the big table. They were far below the capital threshold for an ISDA master agreement, the standard contract needed to trade credit default swaps. So they enlisted the help of Ben Hockett, a retired securities trader who used his connections to get them access. So the bets were placed. Burry, Eisman, Cornwall. Each of them had put real money on the line, convinced the housing market was a house of cards. But here's the thing about being early. On Wall Street, early and wrong look exactly the same. While genuinely accurate, here's what the movie doesn't fully convey. For these investors, the wait was agonizing. Even though the short sellers were right, the trade nearly destroyed them before it paid off. Burry had to pay roughly $100 million in total premiums on his $8 billion in notional CDS exposure, draining capital month after month while the housing market continued climbing. By the third quarter of 2006, Scion's fund was down over 17% for the year. His investors revolted. Some demanded withdrawals. Others threatened legal action. Under immense pressure, Burry had to restrict redemptions, essentially locking his investors in, which only deepened their fury. Cornwall Capital's partners questioned whether the entire system was about to experience something they couldn't even articulate. Ledley reportedly told his mother he feared they might be facing the end of democratic capitalism. And yet, through all of that pain and doubt, one more investor was quietly building the largest bet of them all. A bet so big, it would eventually be called the greatest trade in financial history. John Paulson was a relatively obscure hedge fund manager who had spent his career in mergers and acquisitions. In 2005, when his analyst, Paolo Pellegrini, produced a single chart showing inflation-adjusted home prices rocketing far above historical trends relative to wages, Paulson saw what others refused to see. The entire housing market was a bubble. Like Burry, Paulson bet against the market using credit default swaps, but his scale was staggering. At the peak, Paulson held insurance on $25 billion worth of subprime mortgages. He paid roughly $300 million a year in premiums, hemorrhaging cash while the market kept climbing. Colleagues at investment banks scoffed at him. Even Goldman Sachs experts told him his strategy was completely wrong. Paulson was unmoved. "Listen to the logic of my argument," he told skeptics. The vindication began in the spring of 2007. As subprime borrowers defaulted in record numbers, the CDS contracts Paulson had bought at bargain prices began soaring in value. By the end of 2007, his flagship fund had gained 590%. Paulson's firm earned $15 billion in total, dwarfing even George Soros's legendary bet against the British pound. Paulson personally took home nearly $4 billion in a single year. But it wasn't without controversy. Paulson had worked with Goldman Sachs to construct a now infamous synthetic CDO called Abacus 2007 AC1, allowing him to bet against specific subprime securities. The SEC later alleged that Goldman failed to disclose Paulson's role in selecting the underlying assets, essentially loading the CDO with the worst mortgages available while selling it to other investors as a sound investment. Goldman settled for $550 million, the largest SEC penalty against a Wall Street firm at the time. Paulson himself was not charged. Paulson's payday was the headline, but he wasn't the only one collecting. When the crash finally came, the short sellers were vindicated, but it was a hollow victory. Burry's fund ultimately recorded returns of 489%, earning his investors approximately $725 million. Iceman's FrontPoint fund doubled up from $700 million to $1.5 billion. Cornwall turned $110,000 in a Schwab account into over $120 million. Two guys from a garage had just out-traded the biggest banks on the planet. Paulson made $15 billion. But each of them understood what their profits meant. Ordinary people were losing their homes, their jobs, and their futures. As the FrontPoint team discovered during their field investigation in South Florida, mortgage brokers had been selling predatory loans to families who never had a chance of repaying them. The short sellers' winnings came directly from the wreckage of millions of lives. Burry would later write in a New York Times op-ed that anyone who had studied the markets carefully from 2003 to 2005 could have recognized the growing risk, and that federal regulators had failed to listen to warnings from outside their closed circle. After the crisis, Burry shut down Scion Capital due to public backlash and enormous audit pressures from the IRS. But if you walk away from this story thinking it's about a few clever people who got rich, you've missed the point entirely. The story of The Big Short is not a celebration of people who made money. It's an indictment of a system so broken that the only people who understand it were the ones betting on its destruction. In the end, only a handful of people in the entire world, perhaps as few as 20, saw the crisis coming and had the conviction to act on it. They were mocked, they were dismissed, and they were nearly wiped out before they were proven right. Their story is a reminder that in a market full of noise, the most dangerous sound is silence. The silence of a system that refuses to question itself. And that's the story of The Big Short. If you enjoyed this video, be sure to check out our previous video covering the full story of the 2008 financial crisis, and we'll see you guys there.